Good.
Oh, so old of books. They're so old.
Good morning, everyone. Good mid-morning. If you could take your seats, please. That's fine. We're going to get started with our next session.
It has been, though. Yes. We had quite the cold spell.
Just give people a few minutes to sit down. So yeah, good morning again, and welcome to this next session. My name is Susanna Rust. I'm ESG editor at Investment in Pensions Europe, IPE. We're an institutional investment publication dedicated to European pension funds. And I'll be moderating this session on investor expectations in a changing world. The idea for this panel is to hear key asset owners' position vis-à-vis sustainable investing at a time of heightened scrutiny and, of course, the high-profile retreat and clampdown in some jurisdictions, most notably the US. Is it just the narrative that has shifted, or are asset owners' positions also shifting? I'll just do some very quick introductions before we get started. And the idea is we'll have discuss a few questions and then eventually open up to the floor for questions. So we will be hearing from, it's on your left, is Richard Manley, who is Chief Sustainability Officer at Canada Pension Plan Investments. He's been in that role since 2019. Before that, spent several years at Goldman Sachs. He is the Chair Emeritus of the ISSB Investor Advisory Group and a former member of the TCFD. Sitting next to Richard, we have Laura Hillis, who is Director, Climate and Environment at the Church of England Pensions Board, and the former lead of Climate Action 100+ for the APAC-based investor group on climate change. And then next to her, I'd like to welcome Barbara Svan, President and Chief Executive Officer at University Pension Plan Ontario, UPP. Barb's is the co-founder of the G7 Investment Leadership Network and a member of the Canadian government's expert group on sustainable finance, and former Chief Risk and Strategy Officer at Ontario Teachers Pension Plan. So to kick things off, I'd like to ask each of the panelists to give an overview of your pension fund. You know, where and how do you invest, external versus internal management, who are your members, you know, what is your mandate, and perhaps just a few initial comments on why you integrate sustainability. Richard, if we could start with you.
Yeah, can everyone hear me? Yeah, okay. So CPP Investments manages the assets of the Canada Pension Plan. The balance sheet net is a little over $700 billion. The reason I say net is there's a gross balance sheet, there is leverage in the fund that takes it over 800. The assets are about 85% invested in equities, 15% credit, and 20% sovereign debt, so you can see where the leverage is coming from there. About 55% private, 45% public markets. Most of the assets managed internally, really with the exception of the private equity funds program. The real estate portfolio is managed with external partners and some of the alternative investments. So active equities, sovereign debt, credit, all of the infrastructure assets, the energy assets are all managed internally. Our mandate is really defined from an act of law. It's called the CPPIB Act, and it requires us to maximize returns without undue risk of loss, taking into account other factors that would effectively inform the sustainability of the fund. So nowhere does it require us to consider sustainability or climate change, but we are firmly of the belief that companies that proactively seek to identify and manage risks presented by sustainability factors and climate change, and investors that seek to do the same will in the first instance deliver superior long-term durable value creation, and in the sense of investors, superior long-term outperformance. So whilst not required to do it, it is one of our investments beliefs that we will be more successful investors if we can be successful in integrating sustainability into how we invest.
Thanks. Thanks, Richard. Laura, could we move to you?
Sure. Hi, everyone. So I work for the Church of England Pensions Board. We are a pension fund based in the UK. We have about £3.4 billion in assets under management, and we look after the retirement income for about 44,000 beneficiaries who, as you can imagine from our name, are the people who've worked for the Church of England, either currently or previously. So, a few comments on how we think about responsible investment and climate change. So there's kind of two reasons we focus on this, I would say. The first one is fundamentally we are a faith-based investor. And so when we think about ethical issues, we are very much informed by the Christian tradition. And the way we do that is we have an ethical investment advisory committee. It's important that I say that they don't provide investment advice. That would not be appropriate. But what they do is they help us to interpret really what the Christian tradition says about different ethical topics so that we can try and integrate that ourselves into how we invest, which you can imagine is quite a complicated thing to do. But if anyone is interested in that, there's actually quite a lot of information on our website about how the Ethical Investment Advisory Committee sees different topics like the extractive sector, nature, deforestation, etc. And then the other side of it, which is really where I spend most of my time, is looking at the financially material issues. And you can imagine there's a lot of crossover between these two, but I do think they are separate. And so a lot of the work that we do on climate, on nature, on other topics is very much driven by the fact that we see ourselves as a universal owner, and we see ourselves as very much a long-term investor. So our youngest member will retire in the 2070s, and when you think about the kind of world that they might be retiring into, and the kind of portfolio changes that might happen to our portfolio over that kind of time horizon, we absolutely have to be thinking about systemic risks and systemic financial risks like climate change and nature. And so that's why we really take a very systemic stewardship approach to how we think about stewardship and investment and incorporating that. Just to add a couple of comments just on kind of to kick off the kind of purpose, I guess, of the panel today. So I would say that investors are always investing in a time of uncertainty. I can't remember the last time we felt like life was this uncertain and the economy was this uncertain, but we are good at this. This is what we do as investors, right? People in this room, I think, mostly work in the investment industry. Investing in uncertainty and using different data points to try and come up with an approach is what we do. So I think in some senses things haven't shifted that much. And the other thing that I would say is that hasn't shifted that much is the fundamentals. We are still an ethical investor. We are still informed by those positions of the church, but also the positions of what our beneficiaries would like us to be invested in, and we take that into account. But fundamentally, we are also still very concerned about the financial systemic risks that we face. So in that sense, nothing about what is going on currently in the world is changing any of those fundamentals for us. These are all still financially material issues. The one thing that I think has changed, though, and I think this is a really interesting space for discussion, and I've heard a lot of discussion over these 2 days here about this, is how do we have the most impact on those risks and on addressing those risks? What's the best way for us to act as a pension fund in the short, medium and long term to address those risks in light of where our asset managers might be? Maybe they're US-based asset managers and they're having a really difficult time at the moment. In light of things like the IRA being rolled back in the US, in light of other changes that might be happening, in light of different delays to EU-based legislation that we're seeing. So I think that there are a range of different things that we need to be responding to in terms of how we do this well in this environment, but the fundamentals of why we do it haven't changed.
Thanks very much, Laura. And Barb,
So I'll give a quick description. Some of it may have heard it yesterday, but University Pension Plan was set up only about 4 years ago. So it is a relatively new pension plan in Canada. It was created to bring together the separate and disparate pension plans of the 30 or so university plans in the province of Ontario. So each of them were managing them on their own, and typically they were $2 billion, often $1 billion or less. So there's a lot less they can do. And managed as a jointly sponsored plan, they could avail themselves of some special rules by the province in terms of being able to focus on the long term and not have to worry about risks like bankruptcy of the organization. So we were built by and for the university sector, so that definitely goes through the values of the organization. We're about 41,000 members and $13 billion. The approach was to start with 3, which is what we did in July 1, 2021. And to give you a sense, I was brought in just over a year earlier, and literally I could not buy the stapler because there was no delegation of management authority. So we started with really the inherited assets, no people, no technology, and this was in the middle of COVID. So the group here is now about 260 people, and we have taken on the assets of those founding organizations. We've brought in 2 more universities and their multiple pension plans. We have another one coming this January, and we hope to bring in 1 medium to large or a couple small each year to capture the province over the next, this is a long-term effort, so the next couple decades. The design is pretty straightforward. They get to keep what they had before. We take it all over, and then there's a new plan text, new pension benefit, and the technical term I can come up with is we smoosh it all together, and we deal with the complexity. Dealing with the university sector, and plus my past life at a larger pension plan, to the reason why we do this, it goes to the heart of working in the best interest of plan members. We really feel similar to Richard and Laura. This goes down to the heart of making sure that people are managing the risks of this plan over the long-term horizon, and also evaluating the opportunities with that same lens. So as a pension plan, I call it mid-size, and we will always be a mid-size. We're targeting different sorts of managers. We work primarily through external managers. However, we, at this size, are doing private investments, but in terms of working with GPs, but also doing co-investments with them to help bring down the cost and also bring up the portfolio quicker than we can just through GPs. As a long-term investor, I'll just say summaries, we feel that we have a responsibility to promote the health of the capital markets, and we will not be successful unless there's a healthy financial market, environmental and social systems underneath. And so we can't do impact investing for impact's sake under our legal framework, but we definitely do think of the impact that we have with the investments in our portfolio.
Thanks, Barbs. So Laura's already tackled this next question, which is absolutely fine, but maybe if I could turn to you, Richard, to just dive into this question about the change that we have been seeing, the macroeconomic changes, geopolitical changes, obviously the pullback and clamp down with respect to sustainability, especially in the US. How has that affected CPP? How is your approach changing or not changing?
Yeah. So I'm not sure everyone's going to like what I'm about to say. But
that's a good start. I like that.
The reality is that sustainability done badly is itself a threat to the sustainability agenda. And I think it is fair to say that over the last few years, we saw some approaches to integration of sustainability that were making claims that could simply not be evidenced. And that's the manifestation of sustainability done badly. Sustainability is not a product, it's not a marketing tool, it is a way to consider factors that pose risks or present opportunities to industries and companies and ensure they are appropriately considered in estimating the intrinsic value of the company. And I would note that actually the tide has just gone out on sustainability. It's actually the 3rd time it's happened this century. The 2 prior occasions the tide came back in, I think it's fair to say, the approach to sustainability came back stronger. It came back more grounded in value and less grounded in values. And I think actually built institutional conviction in why people should be integrating sustainability, both in the corporate boardroom and in the investment committee. So yes, the tide has gone out, but pendulum swing, tide's come back in. We have every expectation it will come back and that it will come back stronger. So from our approach to integration, really nothing has changed. The one thing that I will just lead into now, I think we'll probably come back to it, is one thing that has happened over the last few years, and that is that the policy environment in terms of driving decarbonisation has somewhat deteriorated. I think the policy environment for COP26 was about 1.8 degrees of warming. We could be as high as 3.1 by the time we get to COP30. We estimate the tipping point in terms of where the present value of physical risk equals the present value of transition risk is 3.1 degrees of warming. So having previously, I'd say, focused most of our efforts on underwriting transition risk with a view that we would hopefully defer or avoid building physical risk in the system. We have now had to, I'd say, increase the focus we place on underwriting physical risk, facing the prospect that physical risks will be larger than we had anticipated as recently as 3 or 4 years ago.
Great, thanks, Richard. Your comments make me think of the previous panel a little bit about how people are saying that things are getting a little bit more realistic now. There's more of a focus on the economic feasibility of corporate pledges, that there's perhaps progress being made in this respect. And there was also a little bit of some mentions of adaptation rising up the agenda, which I think links into your point about physical risk.
I'd say on that, we have definitely seen the system evolve from a state of ambition to one of action, which is, I think, a far better, more durable position to be for the long term.
Yeah, great, thank you. Barbs, do you want to chime in and just make your
So maybe just to be additive to my colleagues is, I think the long-term direction is clear. Right? We still need to focus on this topic. As you know, investors are used to pricing in risk. I lived through 2008 as a chief risk officer. It wasn't a pleasant time either. But the pendulum does swing, and you get better tools, you get better data, and you need to keep at it. So I think that's the way that we see it. We continue to work with our external managers. We don't ask them to be perfect. We ask them to progress in certain areas. We want to make sure that they are doing thorough due diligence, and that due diligence is with the investment teams, not with the side team. But we are realistic in terms of what they're willing to disclose publicly versus whether they're willing to have conversations with us. And I think that maybe is the one thing that we are quite realistic on in terms of their difficulty in their positions, in terms of speaking out, especially if they have large U.S. operations and those sorts of things.
Great, thank you. We're going to dive into some of the points that came up in these remarks, but I just want to do like a little sidestep. I want to just spend a couple of minutes on the topic of net zero goals and investment frameworks. Again, as we kind of heard earlier, there's increasing uncertainty around whether the world will reach net zero by 2050, which is the goal that a lot of investors have aligned themselves with. What are your thoughts with respect to this question of whether sticking to those long-term net zero goals is going to impinge on your ability to deliver your investment mandate, hit your financial performance goals? And yeah, Barbs, could we start with you on that one?
Sure. So the University Pension Plan made a commitment to be net zero by 2040, in part because we felt that the transition was going too slowly and that we'd rather to be ahead than behind. Also, given the size of the organization and the pool of assets and the ability to go global, it's a lot more feasible at this size than at the extra large size of some other funds that maybe are focused in Canada or focused in regions that are having a challenge transitioning. So that's the framework we're coming at it. We made interim targets, and we're doing quite well on them, mainly because we inherited all these assets and we had to put some sense to them. We inherited over 100 managers, just to give you a sense, and 120 mandates. And that is just the beginning of the complexity. So as we evolved that portfolio, bringing in the climate lens early was really important so that we didn't have to make too many changes as we go forward. We're doing well in terms of our targets, in terms of implementing them. Some of that is because the way the markets have worked out. So for the moment, we're waiting to see if the pendulum swings again before we go out and change them. It's really hard to change them when you're actually hitting your interim targets. And so we are waiting to see probably for a couple more years, and then we'll decide whether we need to change that, because ultimately we have a fiduciary duty to the members, right? So it's not the target that takes precedent, it's the ability to actually deliver the pension promise, and so that is the lens of which we'll look at it.
Great, thank you. Laura, can you jump in on this question?
Sure. So I'm not sure I accept the premise, to be honest. I think with 25 years still to go, it's too soon to say whether we're going to be hitting net zero by 2050. The second thing I would add to that is I get very uncomfortable when the investment sector starts sitting around and pontificating about matters that should be left to policymakers and scientists. Like, fundamentally, we are responding to signals that they set, and I think that is appropriate. And that's why we've seen a lot of commitments from investors that have really, hinged on this net zero 2050 goal. The other thing that I would add to it is, it's clear to me, so a couple of things are clear to me about the pathway we're on now. One is that the fair share approach, which was very much codified in the Paris Agreement, is the right approach and is starting to play out. We're starting to see some very ambitious commitments from industrialised economies, which is absolutely appropriate, where they're going to be reducing emissions very, very significantly in the 2030s, and good indications that some of them will probably hit net zero at a jurisdictional level in the 2040s. What is going to also happen, though, is emerging economies are going to take longer. But as I said, the Paris Agreement was signed a decade ago, and it absolutely said that this would be the way it would go. It was about the kind of fair share pathway. The second thing I would say is that from an investor perspective, I think the net zero 2050 market signal is important. I think it matters. It shows that we are keen to embrace the tools, we're keen to talk about the ambition, and we're keen to understand dependencies and what this looks like for us as really important actors in the economy. So I think it matters that investors have made that commitment. But there is a difference between ambition, and net zero 2050 is an ambition, and it's the right ambition for us, I think, particularly as pension providers, because what we know from the data very, very clearly is that it is the best outcome from a financial perspective for our beneficiaries. 1.5 is also the best outcome from a financial perspective for our beneficiaries. The problem is, what we're increasingly seeing, and particularly on 1.5, is that we are increasingly very unlikely to get there, and that is deeply sad on almost every level you could possibly imagine, but including for our beneficiaries who we are looking after the retirement income for. So I think the question then becomes the difference between, for us as investors, the difference between ambition, what we think the best possible outcome for the economy and for our beneficiaries is, and then practicality, the reality of the day-to-day of how we actually invest. And I think we need to be clear about what we're talking about when we're talking about the two different things. One thing is about the ambition that we take to policymakers, the ambition that we signal to the market, because we know that this is where we should be going and where we want to be going to get that best outcome. And the other part is the tools that we apply day-to-day when we're making investment decisions, the conversations that we have with companies about their decarbonisation pathways. And as has been said on a couple of panels, including the previous one, it's not necessarily realistic to sit down with a company today and say, hey, can you please get on a 1.5 pathway? Or as I think it was Ellen Quigley said yesterday, we want you to lose money, please, in the short term in order to reduce the risks to the rest of our portfolio. That's not a realistic conversation to have. So I think we can still stick to our high-level ambition that really focuses on the best possible outcome for our beneficiaries, while actually using more flexible tools and thinking about how we align our portfolio in a way that is ambitious but is also realistic and practical with the realities of the economy that we're actually invested in. And I think just generally we've probably focused too much on 1.5 alignment as a proxy for ambition from investors, and I think we're moving away from that, and I think it's a really good thing that we're moving away from that and moving much more into thinking about policy advocacy versus investment strategy.
Great, thanks. Richard, I know you've got a slightly, different position, but
no. I mean, having just heard Laura, I'm not sure that's the reality. I think we are still in a world where the majority of governments are providing forward policy guidance of their intention to comprehensively decarbonise their economies by the middle of the century. And while it may be looking more difficult to achieve that outcome today, unless they abandon that intent to regulate, I think we should be investing on the assumption that policy interventions will be forthcoming that impair the value of companies that are unable to align with that guidance. I think Laura has identified another challenge, though, and that is net zero can be interpreted in one of two ways. It is an endpoint if we pass the finishing line having comprehensively decarbonised the economy by 2050, or there is we maintain alignment with a carbon budget of 1.5 degrees. I think the former is still an absolutely reasonable ambition to be shooting for. It is the latter that is becoming a little bit more challenging. And some of you have probably seen that there were several hours of May where we were operating at more than 435 parts per million in the atmosphere. So there's not a lot of budget left. One thing that I think is a debate that we really have to have is that we've been through several cycles now, I'd say, where civil society has sought to engage in what I would call a single actor solution. If only governments would regulate, if only the oil sector would cease to produce, if only the rest of the real economy would decarbonize, if only the financial sector would divest. And it's quite clear that we cannot solve a system-level problem with single-actor solutions. We need effectively a system-level solution, and that will require the alignment of policy with corporate strategy, with underwriting principles. And I think the other thing I'd say is that several years ago, the mantra that emerged for the role that the financial sector should play was in the reduction of financed emissions. And the risk of that is inadvertently that you weaponize the financial system to pursue a divestment agenda. And just as you can't cut your way to growth, we can't divest our way to net zero. We are in a simple situation today where 5% of the economy is green, 95% is grey. If we double it, and double it again, we will have 40 percentage points of economy that is green, but we will still have the original 95% that's grey. 70% of the economy will still be grey. So if we stigmatize transition finance, that is, the investment in grey assets to support their decarbonisation, which is implicitly embedded in having effectively emissions reduction pathways, if we only use the tool of growing green and confront the reality that growing green is proving harder than it was perceived to be 3 years ago, we forego leveraging the other real tool we have with finance, and that is to mobilize capital to green the grey sectors of the economy. So I think it's very helpful that we have seen, I'd say, a reframing of finance's role, and that is mobilizing finance to pursue an investment agenda in the financing of emissions reductions. But I'd say whilst the narrative has changed, I think we're yet to see at scale the deployment of capital to support transition finance in grey sectors.
Do either of you want to come in on with that? Otherwise, I will guide us. No, thanks very much, Richard. Just made lots of interesting points there, and Laura, you brought up you mentioned policy advocacy. Richard talked about the sustainability movement having too strongly focused on single kind of actor solutions, and we increasingly have this kind of systems perspective. How are you going about working on kind of greening grey sectors, and how is engagement with policymakers a lever that you're increasingly turning towards, and how is that working so far? I think, Laura, could I turn to you on that?
Yeah, so one of my reflections, and you mentioned in your introduction of me that I used to work on the Climate Action 100+ initiative, and we're still a really active member in that initiative. One of my reflections on that initiative is I think that it created a framing for investors to come in and talk to companies about climate change in a really robust and comprehensive way, and en masse, like it created that kind of power dynamic that Catherine was talking about yesterday on the stewardship panel. And I think that helped really push the opportunity for company net zero targets, for transition plans, and start to create that much more sophisticated dialogue on climate change between companies and investors. And that has all been really, really helpful. But we've almost gotten to a point where I feel that a lot of companies are at, maybe not the limit, but a lot of the lower hanging fruit, the easier things for companies to achieve that were cost effective, that were technologically available, that were aligned with where the policy settings were, have either been done or have been already planned for and incorporated into transition plans. And so I think we're not reaching the limits of engagement. I think that, I wouldn't say that, but I think we've kind of achieved a lot of the big early wins that were possible through a lot of those engagements, particularly when you're talking about those very heavy emitters in the economy. So I think that has been both successful, but almost we're at a point now where we have to go, okay, how can we have more impact now? So some of the ways that we've been thinking about it are not just direct policy engagement, I will come to that, but the other part is lobbying. I just asked a question on that in the previous panel, partly because I think it's a really interesting indicator when you're evaluating a company's approach to climate change, because what I have often found when I read a company's transition plan, and I might think their transition plan is excellent, I might think that they're saying all of the right things, that the technology pathways is there, the capex is there, the targets are there, it all looks really positive. then when you look at what they're lobbying for from governments, it's weirdly completely opposite to what they say they want to do in their transition plan. And why is that? And so it does start to call into question that credibility piece. Does the company actually credibly have a real commitment to do this? Because if they do, then why are they lobbying against it? And sometimes it gets you into really complex conversations with companies where they sort of say, well, we're not lobbying against it, we just need different ways of thinking about this or different elements of flexibility, which I think is understandable. There's also a transparency issue there, so there's a whole range of different things I could talk about, but that is all to say that we've increasingly started to get the perspective that stewardship discussions can be very fruitful when you start talking about policy, because that's actually where those kind of dependencies come in. So that would be the first thing. Then the second thing is, as I said, I think, when a lot of those early wins have happened with companies, and many of them are saying policy barriers are the issue that's getting in their way, I think it starts to make a lot of sense for investors to then be thinking about the policy track. And just in general, I'd say it's not something we've done a lot before. When I look at most investment managers, very few have big policy teams, some do, but there's not a lot of policy capacity necessarily in the investment sector. It is a whole different world too, like the way policy, the way the sausage is made in policy settings is really different to how most of us are used to kind of operating when we come from the corporate or financial sector. So it actually is a really important skill set. We haven't had a lot of that in the industry, but I really feel increasingly that this is an area that investors are starting to turn to and think, how can we do this better, smarter, and make this really consistent with the way that we're also talking to companies. And then the other component of this is, of course, sovereign engagement, which again, I don't think has had a huge amount of focus from investors to this stage, particularly sort of asset owners. But there's some really good things coming out. Like one is the PRI have a sovereign engagement program now, which has started off small, but it's getting bigger, which is really exciting. And you hear great things about what they're achieving, so that is a really exciting development. And the other thing is ASCOR, assessing sovereign climate risk and opportunity, which has been run by the TPI out of the London School of Economics, which is starting to actually do assessments of the climate plans, commitments, green capex, all of those sorts of things from countries, so that if you are an investor from one of those issuers, you can actually have better conversations at a sovereign level on climate and climate commitments, which I think is just a fantastic development as well.
Barbs, could I ask you to come in on
Yes,
this point?
so big fan. So if I go back to a prior life working with the government in 2018, 2019, I was part of the expert panel on sustainable finance in Canada. And probably one of the most popular questions we would get by people at that point is, whose job is it to work through all this? And our answer just became everyone's. And when you look at that panel report, it's actually not just recommendations for the government, but it was recommendation for different parts of the official sector, for the asset manager and owner community, for the stock exchanges. So all the different players, what they needed to do, even though it was a federal report, and we couldn't mandate anyone else to do things in any way, shape, or form. But we said, here's where different groups can have a impact. The other thing I found that was incredibly valuable around this policy engagement is do not think that the people who are working in government have an understanding of your world when you manage money day in, day out. So the amount of market insights that we got while we worked on this panel, and we still have the book that's about this thick in terms of all the feedback that we got. We said we needed to continue that, and that became the follow-on 3-year effort I mentioned yesterday as the Sustainable Finance Action Council. And the other thing is that the different players, even within the financial system, have different views. So typically, asset owners are much out here because they have the longest view. You take banks who work with corporates, probably are closest to the corporates, and our level of short-term, pragmatism. How do we make sure that this debt issuance is successful? How do we make sure the company has a successful year or two? And then you have asset managers somewhere in between because they have mandates from people. They can't just go and change those mandates with people. And the insurers, depending on whether they're life or P&C, they bring in a different view. So actually capturing the whole of the financial system, not just the asset owners, is really important, because you want to be able to go back to the policymakers and actually say, this is, as a collective group, what we think you can do. And it's usually around what are those key foundational elements that they need to support, and then where are the policy gaps, whether it's for different sectors. in terms of helping them be profitable in this transition, what other type of roles, whether it's even just to get project approvals quicker, or is it in elements around blended finance and how they've set up their infrastructure banks or that sort of thing. So, I think engaging with policymakers, you need to do it very strategically. You can't, not just one-on-one, because they will hear different things. The other thing I've learned through my experience the last 7 years is you need to repeat your conversation over and over again with every department across, because don't assume that it translates across the different groups, because they too just are busy people as well. And they have different perspectives, and also the people in those roles change over time. So it's not a one and done thing, it's actually you need to do it on a consistent basis. So in terms of policymaker engagement, I think as local investors, we can do a lot in terms of our own policymakers, being able to say, what do we actually see when the companies that we're engaging with? So I chair the Canadian equivalent of Climate Action 100+ Climate Engagement Canada. And one thing we do is we actually get funding from the Environment Department to do our benchmark assessment. And one thing we do with that is then bring it back to them and say, this is what we're seeing, here's where we're seeing improvements, here's where we're seeing the gaps. And then we repeat that for every other department that we can get into, finance, the economic development group. And so that when they're thinking about setting up policy, they actually think about, maybe we should talk to this group, or maybe we should go through us to find who are the right groups to talk to and see where we're actually making gaps. And so there's an element where you can actually take the work that you do on the corporate engagement and share it back with policymakers and hope that they make smart policies. And I think, in terms of a system, working through a lot of external managers is also working with them to make sure that, they are also active in the conversations to the extent that they're comfortable with externally, but also internally, in terms of where is their voice in terms of moving things forward.
Great, thanks, Bob. I'm going to ask you, Richard, and then I'm just going to flag that I'll come back to you, Laura, still on this point about policy advocacy, just to keep on using that particular term for this this area activity, to maybe see if you can give us an example or two of some successes you feel that you've had. And I'd also be kind of curious about your views on the development of UK policy at the moment. The UK government has been very busy with industrial policies of financial new consultations. So just be curious to hear your assessment, because I know that pension funds have been asking the UK government to don't just mandate us to invest in certain ways. You need to provide an investable pipeline. So I'd just be curious. But Richard, still first, to what extent is engagement with policymakers a lever that CPB pulls, and what are you doing in that respect?
I'll touch on the other engagement we have as well. So I touched earlier on this notion that a sustainable economy, or one that is climate aware, has these preconditions of climate aware policy, climate aware strategy, climate aware underwriting. And we're clearly not there today. So we have 3 strategic priorities internally for our sustainability strategy. The first is deliver life cycle integration that contributes to improving risk-adjusted returns. That should not be a surprise given our mandate. The second is to upskill our organization, acknowledging that actually sustainability will continue to evolve as a domain over the next decade. I personally am of the belief that physical risk underwriting will be the single largest area of innovation in financial services in the decade to come. And the third is shaping market convention. And that is because we don't invest in a vacuum. We are one of millions of people contributing to price discovery every day. And until everybody is seeking to integrate consideration of sustainability factors into their underwriting, we won't see price discovery informed by sustainability factors. And you could say in some ways, and Barb's already alluded to, that the many different durations that people are investing in the market, that ultimately the way to get there is to have a more long-term market orientation. That requires both, I think, raising and leveling the playing field. And that is one where there is a real opportunity to engage with regulators. Now, you said I'm the chair emeritus of the ISSB Investor Advisory Group. Barb's actually the chair emeritus of the SASB Investor Advisory Group. We both have actively invested in the development of the SASB standards, the TPT, the TCFD, and also now the Greenhouse Gas Protocol. Why is a pension fund so invested in contributing its voice to the shaping of what I'll call critical market infrastructure. Really simply because unless decision makers have access to relevant information, they're simply not going to make the most informed decisions that we need them to. So we have been very invested in ensuring that that information is where it needs to be. But one of the things that has always intrigued me is that the narrative emerged that investors need this information to support price discovery. Yes, they do. But there's always a risk it sounds like we need it to make our lives easier. And we don't. We need it for a different reason completely, and I think this is one that's lost. We don't have many rights, but we do appoint directors. And the reality is our expectations of directors are really simple, that they should be able to demonstrate they are providing appropriate oversight and counsel of the executives to ensure that all material business risks and opportunities, that includes climate change, have been considered in the setting of strategy, its operational implementation, and how they communicate with the market. And if they can't demonstrate that, we have to challenge whether we have the right people in the boardroom. And the good news is every year we get to vote on who should be in the boardroom. And we published a piece last year in the op-ed basically suggesting that directors should be advocating for companies to effectively align disclosures with the ISSB. Because the easiest way to demonstrate as a director that you are discharging your duty to the company is to ensure there's appropriate governance of these issues, to ensure that a materiality assessment has been undertaken, to ensure that material industry-specific sustainability factors and policies are disclosed, to ensure that you've identified the carbon footprint of the company, the sources of those emissions, how you might go about removing them, the physical risks, and how we might adapt to a more resilient business model over the long term. And I think there's a very real debate to be had about whether the engagement that takes place should really refocus on that very, very simple lever of if we don't have the right people in the boardroom, how will we approach effectively the reappointment of directors? So we do regularly engage in all of the consultations that are taking place around disclosure standards. We regularly engage with our portfolio companies and provide the feedback I've just shared. Where there are areas we believe the voice of a large institutional asset owner needs to be, I think, putting a line in the sand. We have something called our Insights Institute, and that regularly is publishing papers on how companies could be approaching decarbonisation of the business, how we might build capacity for pricing climate risk. And that, I think, helps us have a single paper in the market to engage with all of our different stakeholders.
Okay. Thanks, Richard. Laura, can I turn to you just to, given that this idea of policy advocacy is gaining a bit more traction these days, are there any kind of successes that CEPB has had that you'd like to point out? And then maybe just to get any thoughts you have about the extent to which the UK government is heeding investor requests, noting that investors will also have, there'll be divergences of opinion amongst institutional investors, obviously. I mean, especially with the green taxonomy in the UK, we had some groups saying, please, yes, go ahead and introduce the green taxonomy. Others saying, actually, we think your resources are best placed elsewhere.
Yeah, no worries. There's a lot in there, so
yeah.
I'll try and cover all of that. So on WINS, we did some work a few years ago to help, we set up a group of pension funds to work on emerging markets climate finance, which sounds pretty random, to be honest, but the thinking around this was that there is a systemic issue in the global economy, which is that emerging markets simply aren't getting the climate or the transition finance, to your point, to successfully transition, and this is a risk to us. It's a risk to us as investors, because we know that if emerging markets emissions continue to rise, which we expect them to, but they don't sort of sufficiently go down in alignment with those fair share pathways I mentioned earlier, that we are going to see terrible physical impacts from climate change. There is also huge migration risks to countries in the kind of higher latitudes as well, and those kind of social and geopolitical issues could also be quite significant for us, particularly over the long term. So it's really important, I think, for us to be thinking if we are wanting to do something about climate change, and we're actors in the financial markets about how we actually help facilitate the finance to those parts of the world. And so we did a lot of engagement with the UK government, but also with DFIs and MDBs and our asset managers, and just basically anyone who would let us talk to them about this. We were kind of going on and on and on about it for a while. And just a few months ago, the UK government have launched a task force to focus on emerging markets, climate finance, industry-led. So we're part of this. We're one of the co-chairs of one of the work streams. 91, Daisy was on the previous panel. They're chairing the task force, which is great, and it is going to be very much investor-led, but very much a lot of support from the FCDO and other departments within the UK government. So it's a really good start. I would say I don't think that's going to be a success until we actually see the deployment of real capital from asset owners in the UK into those markets, but it's a good starting point. So that's a good success story. And on your second question about the UK government and kind of where they're at on climate change, so they're not making, this clearly isn't a focus for them at the moment, right? Like this isn't the topic that they're talking about the most. But I still think despite that it's obvious to me that the UK is still a shining beacon of climate ambition globally in comparison to other parts of the world. There's some incredibly ambitious policies that have already been agreed in this country. If you look at the Clean Power 2030 plan, like that is an incredibly ambitious plan. Which requires huge investments in grid infrastructure. So I think there still is a huge amount of ambition here. The question is, how does the government now balance the different priorities they have? And, you know, I'm sympathetic to them. They're under a lot of pressure to grow the economy, to deal with cost of living pressures. And so I think for investors, probably the most fruitful avenues of discussion with the government will be those discussions where you can actually incorporate their desire to see greater investment in the UK, their desire to see greater investment in private markets, but also their desire to reduce cost of living pressures for people in the UK. I mean, energy efficiency would be a really obvious win there, where you could be actually asking for more ambitious commitments there in order to help facilitate that reduction in cost of living. So I think that's probably the nature of the discussions I'd expect to see over the next few years, where you have that kind of win-win with other UK government priorities. But yeah, I do think it's important to keep in mind that they are still one of the most ambitious. This is still one of the most ambitious jurisdictions. And just on the taxonomy, I think that the work they're doing on transition plans and continuing to take that forward is incredibly useful, and on transition finance. So I'm really, really pleased to see that. I'm personally not that sure another taxonomy would have been all that useful, just given that there are so many now, and the EU taxonomy has been widely used in Europe, but I'd be happy to have an argument with someone about that if they have a different opinion.
We can have an argument about that, but we've got Canadians here, so we're not going to focus further on the UK green taxonomy. We've covered a lot of ground just now, Barbs. Do you want to come in on any of the points that have been made about the policy advocacy, corporate engagement, expectations of board directors? Our next stop will be asset managers, but I'll just give you a...
So maybe just kind of hit some of the topics. I think some of the wins in Canada, we talked a little bit about how Canada is very federated yesterday. A lot of the securities regulations over pension plans are provincial. But when we look at the 3-year effort with the 25 financial institutions, we got them, so these are 25 banks, insurers, to agree on some really important things. One is the adoption of ISSB, S1, S2, both for the public markets and for the private markets, with proportionality lens to it. So you have 25 of the largest financial institutions, probably 90% of the Canadian financial system, telling the government this is really important. They also agreed, unlike the EU taxonomy for the UK, not so applicable for Canada, and they actually agreed to the Canadian a green and transition framework, which were later adopted by the Australians. And we have seen both these elements in Mark Carney's pledge around in his campaign, in terms of being able to issue transition debt into 2026, or probably early 2027 at this point. So, that is a big win, and to this day I still get calls both from the government and those people who were in those committees. There's still standing committees on it, so the topics haven't ended, which I think is a win for Canada. We talked a little bit yesterday of how long it takes in Canada because of the federated system. So I would see that as a win. In Canada, in terms of also engagement, OxSFS, if you look at the fact that they did a very progressive B15, which is around climate, I would say even recently they've reduced how much capital is required on infrastructure debt, which will, to your point, actually unleash a lot of capital from the insurance sector into infrastructure that is so sorely needed in Canada, and because they did the time to did the risk review and understand the implications, so the elements around physical risk, et cetera. So I think those are, you see a lot of smaller ones that often don't hit the paper. In terms of corporate engagement, I think, that when you look at the elements of Climate Action 100+, which we adopted in CC, it's not about being prescriptive. So we're asking for a strategy, but it is the company to say back, what is the strategy? We are asking for governance, and it's their job to come back to us and say, this is what we think is reasonable. It's our job to use our votes. And so, when you look at that benchmark, I think there's a lot of good elements you can see of what asset managers and asset owners are asking for of companies. And the benchmarking work does illustrate, at least for Canada compared to the global, we're behind like 4 or 5 years of where the global players were. Some of it's just size. What's interesting to see is where have we made progress since we started the initiative, and it's actually around people starting to talk about decarbonization strategies for these companies. And so even though they haven't put all the metrics to it, you're starting to see real tangible differences in the engagements and wins around disclosure, them tackling scope 3. So there's a lot of tangible examples that you see at a much lower level that never make the paper.
Great, thanks. Do you want to come in,
I just
Richard?
follow up on expectations of companies as it pertains to transition plans, because maybe share some perspectives on actually how we engage with companies. One of the first things we'll say at the start of a meeting is that we would like to begin this meeting by expressing our respect of the triad. That is the discrete roles, rights and responsibilities that accrue to us as the owner, you as the director, and them as the executive. Executives are obviously responsible to the company but accountable to the board responsible to the company but accountable to us. And what we're seeking to present to them there is it is not our intent to encroach in your duties. We have no intent to pierce the corporate veil. What we do want to understand is how you're actually providing oversight of this company and how the company's been run. And pre-COP26, we actually published a paper that presented an alternative way to look at greenhouse gas emissions. We obviously think scope 1, scope 2, scope 3, really helpful for accounting. But there's another lens to look at emissions for corporate strategy. And that is there's actually only 4 kinds of emissions. There's those that are proven, technically and economically feasible to abate today. That's anything that's efficiency related or anything that is economic to invest in now. There are probable, and that is if we effectively assume current regulation, current technology costs, but an escalating carbon price, those that are likely to become economic at, say, $100 a ton. On the likelihood that regulation will probably tighten, technology costs will get cheaper, it will probably become economic before we get to $100 a ton. There's a third bucket that is just simply uneconomic. And you can pick your number for uneconomic, whether it's 100, 150, 200, but we're basically saying these will require moonshot innovations to bring that technology to a price point that it can be deployed. And the last one would be, it's just technically not possible. That this is a chemical process we are going to really struggle to take greenhouse gases out of. But the beauty of those 4 buckets is really that those that are proven should be in the business plan, if not already delivered. Those that are probable should be eliciting an active debate about when we will pull them into the business plan, because we know that a little bit of cost reduction, a little bit of different policy, a slightly higher carbon price, and they're economic. The third, I think, is the one that should be eliciting an industry level and a policy level dialogue about these are not marginal. These are still some way out of the money. What do we intend to do collectively to drive down costs or to create incentives to decarbonize? And the last bucket, is the really hardest to abate. The one thing I say is the beauty of that, and the intellectual honesty of that, is it moves the debate away just from a transition, which is an exciting thing to pursue. It's not good enough. We need the optimal transition. And the optimal transition is the one that removes the most molecules from the economy with the least impact to the economy. And the beauty of putting them into those buckets is we frame the debate about how do we get those that are economic out now and soon to be economic out tomorrow, and actually preserve the budget to deal with the harder to abate molecules that are often the ones that are most regressive to lower income households where we seek to regulate to take them out of the economy. So one thing, we don't actually prescribe what we feel transition plans should be. We believe that the corporate should work out what is appropriate for the company. But importantly, if that doesn't get them to zero, or it doesn't get them to alignment with what is the policy guidance, explain which bits are not possible and what would have to happen to make them economic. And that's the beauty of the UK TPT framework, that it does actually articulate that expectation of preparers to provide visibility not only to their owners, but to the policymakers of where interventions need to have happen in order to move this agenda forward.
Great. The one thing I would say from the engagements and from the work of the groups is when we deal with boards, we often, or management teams who are not into sustainability. When we say TPT, we say IFRS, ISSB, S1, S2, STB. They are confused. They can't keep up. And so one of the things that we're trying to do, because we often get asked what does good look like, is actually leverage all this work and show them how to put the pieces together without creating any new guidance and frameworks, and say, here's an example of an organization in a sector that can transition. Here's a sector that almost can transition, so they, different type of transition pathway or transition plan, and then doing examples of where it is really not affordable today for that company to transition and still return shareholder value. And then start using these as dialogues, both with boards in terms of this is what practically a good transition plan looks like. This is what we're expecting from you. And depending on which bucket they're in, it would resonate. We can use it with policymakers to say this is where the gaps are. And so we're trying to always figure out, how do we promote the dialogue amongst groups in an understandable way? For everyone in this room, all these acronyms make sense. I can tell you when you go outside this room and you deal with companies at different sizes, they don't all make sense and they don't understand how to put all the pieces together.
It's hard to believe that not everyone knows all these acronyms. It's just the bubble effect. I want to move on to an actor and a topic we haven't touched on, but it's a very relevant one. Your relationships with asset managers, as again another part of the ecosystem, another part of the system. And then from a topical perspective, we obviously had some asset managers, leave Climate Action 100+, leave the Net Zero Asset Managers Initiative, and there's, at least in some areas, I think there's an expectation that asset owners will react quite strongly to this, or should maybe. That's one point of view. So just, well, on this topic of, again, external asset managers, which applies maybe more to Church of England and UPB, but have you made any recent changes to your expectations of asset managers, or any such changes in the pipeline? Are expectations of kind of firmer asset owner response to these retreats, these exits from the climate alliances, misplaced? Or I'm throwing out a few ideas there for you. Barbs, can we start with you again?
Sure. So one of the things that we do as part of the Net Zero Asset Owner Alliance, as being one of the members, is we actually co-chair the working group around asset manager engagement, in part to make sure that there's, including guidance out there, but ensuring that there's dialogue amongst those members in terms of what does best practice look like, creating forums where we can share and talk about where some of the struggles are, including the opportunity to meet with different managers, whether they're in Net Zero Asset Manager or not, quietly as a group, to say, here's what we continue expectation is for you. And then, for UPP, we operate through a lot of managers, and really very similar, like what is the governance that they have around these types of issues in their organization? So you always start there, similar to a company. How is it going through the most senior leadership? How does that go down through the organization? Is the due diligence process thorough enough? Can they show us examples? And is that owned by the investment teams, not the side sustainability person? Right? We very much want to see how they're integrating into it. And then disclosure, again, probably one area where we've changed is, okay, we understand the current environment and the difficulty with publishing things, that everyone has legal counsel that they have to go through. Let's get realistic in terms of what's the risks right now that they face. So we say, okay, please disclose this. We also try to make sure that this is helpful in terms of both ways. So pointing them, say if they're in real estate, to things like GRESB and the Global Real Estate Sustainability Benchmark, saying, you know, helping them, especially for us as UPP, we're with more mid-market managers, so we're not looking for perfection, we are actually looking for progress, right? That's the way we think we have impact. We also try to get it very much into the agreement that we sign with them, that we expect these things to happen over the tenure of our relationship. And so I would say that we've stayed the course, maybe just have made sure that we stay out of the limelight on this and make sure that they're comfortable. They have to decide what they're comfortable disclosing and being a part of. We can express, like, we still like to see certain information because we gave you money to manage. So for us to do our duties, you still need to provide it to us. So I wouldn't say there's much that has changed. I think, you know, everyone is disappointed when people leave these initiatives, but, you know, it's back to their organization's decisions and their risk tolerance for what they're going through.
Thanks, Barb. Laura?
So it's probably worth me explaining that all of our AUM is externally managed, so we very much rely on asset managers for our investment strategy. And I might just start by talking a little bit about kind of how we've approached this in the past, and then kind of reflections on, you know, the current state of play. So in the past, when we're looking at evaluating potential asset managers, when we're looking to appoint a new mandate, we absolutely look at the coalitions that they're part of, their commitments, and how they're executing those. One thing I would also add is, because we do our own stewardship in addition to having asset managers do stewardship, we are in rooms where stewardship is happening, and that might be Climate Action 100+. It might be that we're also part of other collaborative initiatives, like we're a member of IRGCC and we're in working groups, and we can see how that, you know, what the asset managers are doing. That is a competitive advantage to them if they're involved, and they're good at it, because we can actually see, if I'm in a Climate Action 100+ engagement and I can see an asset manager is in the room really holding a company to account, asking great questions, I go, oh, they're great at stewardship. And, you know, in the future, when we're potentially talking to them to come on as one of our asset managers, I know that they're good at stewardship. That is quite a good advantage for them to actually be present in those rooms. So I would say that is a very good reason for them to be involved. The other part of that is, because we have stewardship expertise internally, when we are having conversations with them, we're better at asking them questions about stewardship than we would be otherwise. We also can kind of call them out when they're making things up, which they do sometimes. Like, I have had several asset managers explain to me that they secured a particular outcome with a company, and I know for a fact that they didn't, because we have been part of those conversations and we know how those processes played out behind closed doors. So us having both our own approach internally is very, very helpful, but also them being part of those initiatives has been really, really helpful. All of this said, I'm not unsympathetic to the pressures on US asset managers at the moment in particular. I think it's really, really tricky. It's tricky both because of the letters, the kind of legal actions, but also the fact that I think many of them are experiencing quite a lot of difference in opinion between what their clients are doing or wanting from them as well. And that is tricky. Like, fundamentally, their job is to deliver for a whole range of different clients and different client preferences. So I think being clear about what they're trying to do and what their beliefs are is really, really important in that, now that we're moving into this next stage. All of that said, fundamentally, you believe that climate change is a financial risk or you don't. And if you don't, you're probably not the right asset manager for us, I would say, because you're not managing risk appropriately.
Thank you very much, Laura. Richard, and then we will turn to the floor.
Yeah, so look, as I said earlier on, we don't do very many public market strategies through funds unless they're doing something we can't do. And that could be, you know, macro tilting, that could be some quant strategies, that could be some specific credit strategies where there's very narrow markets. So we do have an ESG-DD process for any public market managers, but I think it's fair to say, given the very diffuse nature of those portfolios, given what it constitutes within the fund, it's only really when they say, no, our edge is sustainability, that we will really go deep. And I would probably advise saying it's our edge, because we go very deep. In part because if they're claiming that, we want to learn how they believe they're actually generating alpha from it. In contrast, the private market, which is a very big program for CPP, I think it's fair to say has been later to the sustainability agenda. And one of the things we do there is, not only when we're diligencing a manager for the first time, but annually, effectively ongoing monitoring, we maintain effectively a standardized scorecard of all of the GP ecosystem that we're invested with. We actually have to necessarily advance what that's scoring each year because the capacity is built. I'd say there has been until relatively recently a bit of an arms race in private markets to build capacity, but we're quite transparent with managers then on a no-names basis of helping identify for them where they are demonstrating leadership, where they are conspicuously lagging. But as Laura was saying, the benefit of seeing their diligence process and then seeing them in the engagement room, we have a very big co-investment program. So we get to see what they say they do when they invest, and then if we're co-underwriting an investment with them, when we actually see the due diligence process, I think it is fair to say on occasion we have seen some dissonance between what is actually taking place and what is supposed to be taking place. And actually that's a pretty helpful position to be in. There's certainly some underwrites where we've been able to really support a partner in doing a better job of underwriting. And one thing I'll say is that the private markets, they view themselves naturally through shareholder agreements and management agreements as having greater governance rights than public market investors. And I think that is maybe one reason they felt they didn't need to be as proactive on sustainability. I think many of them felt they were already doing it through their active participation in the boardroom. But I think as we've seen in the last couple of years, some situations where institutions have held themselves out as doing this well, have had some reasonably high-profile banana skins that have consumed a lot of resources to remediate them. Whilst the tide's gone out a little bit in terms of the narrative of what's been said about private market integration, I think the private market runway for continued ambition is considerable and still very much intact.
Great. Thanks very much, Richard. Are there, the questions from the floor? I see there's one in the back. Got a few hands up. Over there, please. That was definite one. I might take a few questions at a time. We'll take 3 questions because that might be all we have time for.
Hi, Sarah Barker from Pollination Law, amongst other things. My question is in relation to tipping points. Sorry, one for Richard and one for Laura and Barbara. Richard, I was really interested in your observations about the fact that you see equilibrium between the present value of risk, physical and transition at 3.1 degrees. So wondering how that's informing your investment behaviour now and how you see that informing your investment behaviour as we head towards 3.1, because obviously we'll know that we're likely to hit it at a much earlier point. And for Laura and Barbara, Laura, your point around the fact that it is less likely that we're going to hit net zero by 2050, certainly given we're now past 1.5 degrees, less likely it's going to be gradual and linear, like all the scenario models tell us it may be. So my question for the two of you is, how are you factoring in the potential for disruption and shock, more so into your transition analysis models now?
Thank you. And then we're going to take the question here from the gentleman. Yes, please, you.
Yeah, hello, Will Goodhart from the Future of Sustainable Data Alliance. I wanted to ask about disclosures. You've all talked a lot about sort of monitoring companies and company performance. And if Omnibus and changes to CSRD and CSDDD go through as they may, the available data points for you to do that will be significantly reduced. How do you think you might respond to that? Are we going to get back to a world where companies get 40 different requests for information to be provided to them in 17 different ways?
Great. I think we're going to take one more question here, and then we'll let you answer them. We've got about 10 minutes left. Thank you. 10, 12 minutes, fine.
Yes, thank you for a very interesting panel.
Great.
I did a survey recently with a global sample of CFA charter holders, and I asked them whether they think that climate risk is an important issue. And most of them said yes, some of them said no, some of them said yes, but of course there's a difference between the regions. Then we also asked them, what do you do with that belief? And then the Americans, on average, most of them said, the Europeans, they pimped up the prices of non-exposed stocks so high that we don't want to invest in them anymore. The Europeans don't see that. We see it. We make a buck by buying the conventional stocks. The other way around, the Europeans say the US people have no clue yet about how important the topic is. And therefore, we buy the climate very well protected stocks so that we make a buck and they don't know it yet. So which asset managers are you going to hire?
Okay, you've got a lot of questions there. I think we'll start with the chronological approach. So if we could, Richard, if you could answer the lady's question with the bank.
So physical risk. Look, relative to transition risk, it is a whole different level of complexity, because really transition risk is simple. How many molecules, how hard to abate, what's the economic cost of abatement? Run a few scenarios as to where prices might go, and you can work out the relative exposure between industries and then within industries. Climate risk, by contrast, is not just the risk at the company's assets, it's the risk to the supply of their raw materials, it's the risk to the critical infrastructure that those materials run along, and then the risk to demand centers. So it is a much more complex problem. Now, if I had one wish, think about, this is a really strange anomaly, but we have index futures, we have stock futures, we have FX futures, we have rates futures, we have commodity futures. The single most important capital market for determining climate strategy is the only one that trades spot, and that's insurance. You can only buy insurance for the next 12 months. But I would say that if we had not firm quotes, because that would require capital against it, but if we had indicative forward curves for pricing insurance risk under different scenarios that allowed boards and investors to see, frankly, the opportunity cost of inaction on adaptation, I think we'd be having a very, very different debate around physical risk. So what are we doing? There is now pretty good desktop solutions to identify physical risk in different parts of the world. You end up with one of two signals. Either it's elevated today, or there'll be a big delta in the physical risk over time under specific scenarios. Where one of those two conditions are met, we now actually typically engage insurance consultants to help us understand what could be the future cost of that. Importantly, because understanding how much insurance costs are going to erode earnings starts to give you a visibility on not only the future cash flows, but actually the future ability to finance the business, remembering that insurance is more often than not a covenant requirement. So the insurance markets are a helpful lever. The way that we're, I suppose, though, philosophically thinking about this is we will know as we enter the early 2030s whether we're going to protect 2 degrees or not. It'll be pretty clear by then. And when we're either going to be in a high transition scenario or a higher physical risk scenario, and is an appreciation that heuristics will definitely evolve in the next 5 to 7 years, that see some rules of thumb emerge as to what might happen to insurance costs, what might be the cost of adaptation. If cash flows are not being expended over that period of time to build resiliency, it's our expectation that the effectively foregone investment will be treated as a contingent liability, and the next buyer will simply expect that to be deducted from the fair value of the asset. And that's really making us think now that climate-aware underwriting, intellectual honesty, you either have to haircut the cash flows, or you have to consider haircutting the exit multiple in order to make sure that you have fidelity in how you're thinking about these risks. So it's still a nascent, I'd say, discipline. It's one that's going to see considerable change, but there are multiple avenues emerging now to start, I think, building that capacity that weren't even as recently as 3 years ago.
Thanks, Richard. I think I was a bit overambitious with taking 3 questions at one time, especially as I didn't jot them down. But I'm going to ask either Barb's or Laura to answer your question, just in the interest of time. And to recap, you were asking about their views about a disorderly transition and how they're factoring that in. Would that be a fair recap? Laura, are you happy to take that? Yeah.
Have a go. Okay. Yeah, thank you for asking the impossible question, Sarah. That's great. So there's a few ways we're thinking about this. So I would say the first one is, back in sort of like 2016, 2017, when the first NGFS scenarios came out and the whole requirement was that pension funds had to do, or the expectation was under TCFD that you would start to do scenario analysis. I just thought, oh, well, great. Like, as soon as we see all the risks playing out on the balance sheet, as soon as we see those scenarios, we'll all freak out and then we'll solve everything and everything will be fine. Very naive. Clearly that hasn't happened, and part of the reason is the scenarios just aren't very good, and I don't know if there's anyone in the room who can tell me why. I don't know. I'm not enough of an expert, but the scenarios aren't very good. When I've seen them done, and I've read heaps of different versions of this applied to different portfolios, and they're just not very good. They basically say 3 degree bad, 2 degree okay, 1.5 fine. It's simply not good enough, and none of them account for the tipping points, which you know. One thing that makes me slightly optimistic on that is the University of Exeter have done some really good work on tipping points and tail events and kind of the impact on those, and they're actually developing scenarios that pension funds could use in the UK in the future. So I think if the scenario modelling becomes more sophisticated, it might start to be easier for us to incorporate into how we're looking at the kind of risk, the risk of this. I would say the other way that we're thinking about it is we have limited resources in all of these organisations, and anyone who works for another pension fund would probably be annoyed at me for saying that, because we actually have quite a good resourcing for the size of fund that we are. But we have to get a lot smarter about how we use the resources we have to do this in the smartest possible way. And to an extent, we have to ignore what some of the scenarios are telling us and actually look at what the IPCC is telling us, because they're not necessarily the same thing. Like, we know that as soon as we hit 1.5, which I think is due to happen in about 2029, coral reefs should start to collapse. And once coral reefs collapse, we know that fisheries could collapse. Once you start to think about the impact of that on food supply and all of the other things that could happen, like those tipping points could be happening in the next few decades. So I think there is an element of us needing to disregard that and actually focus a little bit on what we know from the IPCC is very, very clearly, because that finding about coral reefs is like a very high confidence, almost certain finding. So we know that. So I think we can start to incorporate it into the way we think about doing stewardship, doing policy engagement and addressing risk in a more systemic, cross-functional way, which we have to do if we want to make the most of the resources that we have.
Great, thanks, Laura.
Briefly,
Yes, okay.
because I would agree that just with my experience as a risk officer, really hard from the top down in terms of the modeling. You can get a lot better when you have a specific company in a specific area, and you can go deep in terms of what is the physical risks, et cetera, on that company and through their supply chain. So absolutely agree. One scenario I would love for people to work through, and maybe it's through the bank regulators and insurance regulators, is what if you lose insurance, right? Like, I think that is something that people do not think about, and then what's their ability to get debt? At the end of the day, it is the equity holder that carries that risk ultimately. And so I think, we underestimate, we think it will always be there. It will go up in cost. We've seen it go up in cost, but what if they stop insuring in that particular area? We've seen in different parts of Canada where co-ops are now created and governments start taking this on. So I think that is probably something I'm starting to see more about, but would love to see a truly systemic kind of scenario risk analysis on it.
See, if we can, just 1 second on this one.
1 second.
We have a really good precedent for insurance markets failing, because the corporate liability markets failed in the 80s. And it required companies to set up captives. ACE is probably the biggest of them still around today, that effectively sees companies overnight go from a pure play business into a conglomerate with an insurance arm. Unfortunately, as a former equity analyst, I'll tell you, most equity investors, two of the things they like least are conglomeration and insurance. So if everybody is about to become a conglomerate with an insurance arm, I cannot imagine it will be good for costs of equity. So.
Thanks. Will, I think it was Will who asked the question. So I'm going to try to recap. It was a question about the prospect of, for example, EU corporate sustainability reporting rules being scaled back, and hence the data points being cut back that corporates are reporting on, and investors' thoughts about that? Yeah? Okay. Thank you.
I can start with the bit of the Canadian example, because I think Wall Street Journal reported a little while ago that over 10,000 companies would be caught by the CSRD rules. Of those, 1,300 were Canadian, which is disproportionate for the size of the Canadian market, versus, say, 3,000-ish for the US. And you think of the Canada market versus the US market, right? I think there was a lot of articles and things published on it. There was no excitement about that in Canada. So I don't know if they thought that, when it comes to fruition, or they'll manage it down, or, it'll just be this particular arm of the organization. I checked with the big four, they were having the biggest organizations, but again, not this kind of the same, like, isn't this going to impact you? And they weren't as aligned with is going to have as much of an impact. So I think we will keep going on we want ISSB S1, S2. We had the Canadian group adopt that and started in 2025. We talked yesterday about how many groups it involves to get that done in Canada. So I think there's a big role for investors, as Richard puts it, through our proxy votes, through other means like shareholder proposals, to continue to push for it.
Yep, and then we're going to turn to...
So look, full disclosure, the summer 2022 FRAG consultation, we questioned the merits of Europe continuing to pursue a standalone disclosure standard when the IFRS Foundation had already built a global baseline. My biggest concern about the 1,000+ metrics that ESRS was proposing was actually the neurological response it would have for boards, okay? Because if you tell me there's 25 things that are material for the business, you can probably keep me in the right side of my brain, focused on how to create value and mitigate risk. If you tell me there's 1,200 things that are important for the company, this sounds like a monumental compliance exercise. You're going to move me to the left side of my brain, and that will not be, I think, the way to proactively drive value and protect value from this process. So what we said, our recommendation was that actually Europe just pivot to adopt the ISSB, and we drive global alignment. Now, the announcements last Friday suggest that the European Commission may be even moving towards ISSB light and indicating they feel that ISSB would need to be diluted. If that is where they land, I would propose, given the expectations of many investors around the world, that you should expect engagement to be initiated, saying to directors, doesn't really matter, you need to be aiming for the ISSB, as only armed with the disclosures that would be needed to be prepared, can you have conviction that you're able to discharge your duty to the company.
Okay, thank you. We have hit 12, but if you allow me, I'm just going to take this question. I think, could you repeat it succinctly? And
Hello. Oh,
yeah.
Here we are. So I did a survey. You see that globally, CFA charter holders who work with all the asset managers that you employ have fully different beliefs. US versus Europe, really different. You have to hire these asset managers and you go through a process. And I think Laura said, you know, when they don't have the investment belief that climate risk is important, then they can forget about it. I think you said something like that. But you can still think it's important and still not buy the climate protected companies, or non-exposed companies, because you think they are overvalued. And I just wonder how you deal with that in your decision-making process.
I mean, so I think, so when we're looking at asset managers and we're kind of comparing, we don't really do it on a jurisdictional level, if that makes sense. We do it more on an asset class basis. And so we're looking for who can manage this asset class best. But part of the due diligence of that process is sitting down with potential managers and actually seeing if you have alignment around how you see risk and how they see risk and how they're valuing risk and how they're engaging with companies on risk and how they're doing due diligence and all of those things. And so my comment earlier wasn't necessarily a specific one about valuation. It's more that, and it's certainly not one about asset managers not being in certain coalitions, because I do think that, you know, my reflection on, for example, a lot of the asset managers leaving things like CA100 Plus or NZAM is probably more reflects the fact that they probably weren't doing much with it in the first place. Like, it sort of reflects that maybe it wasn't something that they found particularly valuable anyway. So I don't think, you know, fundamentally that necessarily tells us the information we need to get. I do think it's important though. But more my point is, you can talk to an asset manager and get to the bottom of fairly quickly how they're thinking about it and whether they're thinking it through in a really logical way, and that would be part of the questions that we would be asking. And if they are basically saying to us, we don't think this is a risk, we think it's kind of woke or whatever, then that would immediately say to us, okay, we're not in the same place on this.
Yeah. So I think we would ask for all the usual policies and things, but the key is, you know, asking for examples. And asking for the examples of the companies that you're curious about how they assess. And so that's one way that we try to work at it from before we hire a manager, and then ongoing as well when we have dialogues. Because similar to Richard, we scorecard each of our strategic managers. We work with them to say what's the one or two things that they're going to improve, and did they actually improve it, and how do you actually see that is through examples?
Thank you. We are ready for lunch, I think. Thank you very much to my panelists. Thank you very much for listening, and a round of applause, I think. And,